Welcome to 2024 and Our Mortgage with Me, episode 1 for 2024 with Jeff Mudrick, with Mudrick Mortgages. I'm super excited to have you back. We always have a lot of great conversations when we get a chance to talk about mortgages and what is going on in the industry. So tell us what's happening in the mortgage industry right now.
Super happy to be here. So I know you're aware of this, but yeah, in the mortgage space, we've seen like quite a shift since our last time chatting. So rates have plummeted, and this is fixed rates. It doesn't really hit the news as much as the big Bank of Canada announcements, but yeah, what I mean by plummet is, we were seeing rates at like 6.7% on the fixed side, and now they're down to like 5.2, 5.3, so like a 1.5 point drop. Which is great for many reasons. Yeah, it's great for a ton of reasons. Number one, people can qualify for more, which is nice. So if clients were struggling and they were like capped out on how much they could afford, they could qualify for a lot more right now, meaning go get pre-approved. Number two, obviously it helps when people are coming up for renewals. They're renewing at much lower interest rates. And number three, just, it's good for everybody to have lower rates out there.
Yeah, absolutely. So I've got a couple of questions that I feel as though consumers probably have consuming their mind right now. Let's just focus for a minute on first-time home buyers for 2024. What are the key things that they need to know going into 2024 and going into their first mortgage? Whether they're buying, in the next month or the next 6 months, what is your opinion and advice on what they need to know?
All right. So the first piece for anytime I have a discover call with a client, and I find out they're a first-time home buyer, my first question is, have you opened up a first home savings account yet? FHSA. If the answer is yes, amazing. If the answer is no, we'll talk about it. So essentially what a first home savings account is, it's like the absolute best government program for first-time home buyers that we've seen in years. So there's a $8,000 limit annually, and you put money into this account, and when you pull it out, you get an $8,000 tax rebate on your personal taxes. So it's a tax-free incentive. You'll save a ton of money. And if you don't use it, that's totally fine. If you're planning on buying in the next 5 years, it still makes sense to open one up this year. Even if you put no money in it, it doesn't matter. It's there. So what we've had a lot of clients do, because it just what we've had a lot of clients do, it just opened up last year. So we've had clients buy a property about 3 weeks before closing, open up this FHSA, put $8,000 into it, pull it right back out, and they get that $8,000 tax credit on their 2023 taxes, which is quite lovely.
Yeah, brilliant. Yeah.
There's like
sorry, go ahead.
No, go ahead.
I was just going to ask, where do they open this account up? Do they go to the bank?
Banks all have it now. You can go on like Questrade or Wealthsimple, I think, has one.
Okay.
If you want to do it yourself. Yeah, they're kind of everywhere now.
Okay, perfect.
Yeah. So that's like step number one. Besides that, it's really, as it's kind of been for the last while, it's just like partnering with a team of people who you trust, you know them, you like spending time with them, because as we all know, the experience of first-time home buyers is going to a lot of properties with yourself or with like their realtor, having a lot of conversations with the mortgage side of things, looking at a lot of budgets, running numbers, and then definitely, like, once you have that team in place, making sure they're recommending you to a good lawyer, just having people in your corner, having people that are actually in your corner.
Which is kind of like what we do, with our businesses. We're kind of a one-stop shop. If they come to me first, then they have a plethora of, options of all the world-class professionals that I work with. You have the same, situation as to, they come to you first, but you have all the recommended world-class professionals that you can, put them in touch with, which is essentially what they definitely need. That is
100%. Like, as opposed to the other way of looking at it is, like, I've had a lot of first-time home buyers use their aunt's cousin's friend, or like stuff like that, and the experience is it's not as smooth.
We'll for sure. Just just quickly back to the FHSA.
You got it. Yeah.
If it's a couple purchasing a home, is it 8,000 each?
It's
Individual?
8,000 each. Yeah.
Okay, perfect. So that's good to know.
So each person can open up their own, and then they'll save that $8,000 on their taxes. They're not saving 8,000, but they're saving the percentage of
Right.
that. Yeah, but it's just like there's no negatives to opening it up. That should be step one for anyone thinking of buying a home in the next 5 years.
Yeah, very good to know, because I actually didn't even know that.
It's new, so it's not many people know about it.
Right. And this is why we bring you value, because nobody else probably knows either, but we do, and we're giving it to you. Here's a kind of a hooky kind of question, catchy question. So what do parents of first-time home buyers need to know?
Oh, fantastic question. One is your kids probably will be coming to you to ask for some money because housing prices are expensive and you need it's harder to qualify than it's been in the past.
But they can gift funds for the down payment, correct?
Yeah, every single lender, if you're putting less than 20% down, every insurer allows partly gifted funds. Some lenders don't allow the whole thing to be gifted. Other lenders do allow the whole thing to be gifted. So it's very like bank or lender specific. But yeah, that, the two biggest times we interact with parents on a deal, on a purchase or a mortgage, is for gifted funds, where really all that's needed, it's a pretty simple process. If, let's say, a client goes with TD as their preferred mortgage solution, TD has a specific gift letter that parents will just have to sign a piece of paper. It says, hey, I gift Michelle this amount of money, and then we'll see that amount of money show up in Michelle's account. Done. The other time we see parents, we talk a lot with parents, is to co-sign. So co-signing on a mortgage. So essentially what a co-signer does is allow an individual or two people to qualify for more of a mortgage than they could using their own income. So when a parent co-signs, we get to use all the parents' income, but we also have to use all the parents' liabilities and debt and maybe their own mortgage if they have it on the application as well. So sometimes it helps, sometimes it hurts. It's a very, very unique situation.
But I mean, at the end of the day, looking at those options don't necessarily hurt them in a sense. Like, it could very well be a positive outcome, or the outcome may be that it just doesn't work and they should just continue to do it on their own, right?
Yeah, I would say like 9 times out of 10, it's a positive outcome. The downsides, or maybe we can call it like the risks to the parents to co-sign. Risks to the parents to gift, there's no risk. Parents know what they're gifting. It is what it is. Downsides to co-signing is if so there's a bunch of different ways to structure it. We could talk for a long time about this, but if the children, let's say, are buying a property, parents co-sign, and children can't pay for the mortgage for whatever reason, they lose their job, they just don't want to pay, they cancel, whatever. The lender, the bank, or lending institution can then kind of go after the parents, say, hey, you're on title as well, so we are going to get the mortgage from you instead. And if the kids don't make the mortgage payments, it's going to hurt the kids' credit and it's going to hurt the parents' credit as well. So,
right,
a few things to consider.
Very good. Okay, so we got first-time homebuyers kind of under our belt. So in the case of baby boomers, we're seeing, baby boomers are experiencing, the time and money freedom right now. Most of them have probably retired and have lots of money and lots of time. Are you seeing a lot of baby boomers doing a downsize right now? What are you seeing with the baby boomer industry?
Yeah, I find it actually been super fascinating, because over the last year, I did not see it. Or maybe the last, from January until November or October, didn't really see it at all, because the market was in a down. It was the market
Downward spiral.
Well, there you go, downward spiral. So really, to downsize in a time when it's a downward spiral, it didn't really make a ton of sense. Like, just if we're running the numbers and looking strictly to sell at a loss, and to purchase, if you sell a place at $1 million and the market's down 20%, you're going to get 800,000 for that place. Whereas if you bought at 500,000, that property value doing the same 20% rule was probably worth like 550 or something. So didn't make as much sense. But now, since like November, we're seeing that a ton more. So a lot of clients have come to us to start the process of seeing what the numbers look like to downsize. And I think because the market's turning, if the market's going up, it makes sense to downsize at that time because you get more for your current property.
For sure. Yeah. And I think that's important for them to know because a lot of them are haven't sold a house in a very, very long time, obviously, and probably aren't necessarily up to date with what's going on in the real estate industry. So it's good for them to know, it is a good time to go and to take a look at your finances and make your considerations, at least to if you're in this big giant house and you have no kids and you're sick of cleaning it because it's just too big, then
what we've also had we've had a lot of this recently too, where people who are I don't know, maybe like 55 plus have opted to purchase some investment properties. We've had a good number of these recently. So most of these individuals don't have a mortgage on their current property and they still have some income. They plan on working for another 5, 10, 15 years, accumulating pretty good money. So what these people want to do is, put a mortgage on their property, refinance their house, pull some equity out and put like a down payment on the property in Hamilton or in I've had a lot in Thunder Bay this year, just because rents are very high, and there's definitely an opportunity to get some of that. Even with interest rates being high, there's definitely an opportunity to get like a net positive cash flow.
Yeah, as long as it's a cash flowing property for them, I mean, it's a good investment, right?
Yeah. So we've seen some of that too. It's been an interesting year.
Yeah, I'm excited to see what 2024 has in store for us. Is there any government policies or anything coming down the pipes that are going to be beneficial or maybe not so beneficial to home buyers or sellers in the near future?
Great question. My mentality on everything when it comes to the government is that unless it's in place, I can't even talk about it because it'll change 1,000 times before something gets in place. So until it becomes a law, it's not a law yet. So one thing though is the fact that anyone who purchased a property with less than 20% down has the ability to, upon renewal, so when your mortgage is coming up for renewal, you can transfer to a new lender without having to like requalify and all that. Or you still have to requalify, you just have to requalify using the stress test.
Okay.
It's very particular. So the amount of
Right.
people that we've helped with this is not very large, but that is like one thing that can potentially be helpful to clients.
That's good for them to know, for sure.
Yeah.
Okay, so I guess one of the biggest questions that I'm getting people talking about and are concerned about, and some people like ourselves, and I've told you 100 times that, we locked in at 1.84% in December of 2020. And,
How nice is that, eh? Oh
I
my
know,
gosh.
right? I'm like, let's just ride this wave. But there are people out there right now that are locked into a really good rate, but they want to move. But they're afraid to move because they think that there's no, they're going to actually lose out if they move sooner than their renewal. But there are opportunities for people who have been locked in at that lower rate that they shouldn't be chained down to the property that they're in, correct?
You got 100% right. So what I would advise anyone who has the same thoughts as Michelle just mentioned, first, if you used a mortgage broker, reach out to that mortgage broker. They'll give you the good news that unless you used the discount lender who's like a 0.05%, lower, but they have all these stipulations. If you're using a reputable lender, you are able to bring your mortgage to any property you want. As long as the property fits the lender guidelines, you can bring it. Maybe you're paying like a $200 transfer fee to move from one property to another, but that should be the absolute maximum that you'd be paying. So definitely reach out to somebody that you trust, send them a copy of your mortgage statement, terms and conditions, and they should be able to tell you within 2 minutes if you have a mortgage that is portable or transferable.
Okay. Okay. And so, for the consumer or the homeowner, for the homeowner who has a mortgage coming due in the next 6 to 12 months, how far in advance do you feel as though they should start preparing and looking at options and making considerations to what the next steps are to this?
So we reach out to every client 13 months less a day prior to their renewal, because depending on the lender, we can actually like get, it might be advantageous to renew early without you're not paying a penalty to do so. So we always do it like pretty much a year out. For the average consumer, they're like, I got a call today for somebody who's coming up for renewal February 1st. So that's always fun. But anyways, to save yourselves and to probably being able to shop around and get the best rate and terms and conditions on your mortgage, you want to shop at least a minimum of 4. But I think the safe 4 months out of renewal, but the safe bet would be like 6 months out. That should
Yeah.
be for sure when to start.
Yeah, because you don't want to be put in a position where, tension is high and, the wire is right there and you're not prepared, and then you make haste decisions that may not be in your best interest when you're under the gun and have to make those decisions under pressure. So that's
Yeah, 100%. And just to like give yourselves the best option to save money. Like if we lock in a rate for you 6 months out, and for whatever reason rates go up 2 months later, well, you're locked in. You
right.
have it. You're safe. But we don't want it to go. Yeah.
And then again, we've talked about this before, but anyone who is new, so when it comes to locking in that pre-approval, is yours a 120-day? I guess it depends on the lender.
They're all 120 days. So
Okay.
yeah, you have 120 days from the time that you submit a pre-approval or a rate hold until it expires. So
Right.
if you are purchasing, that means within that 120-day period, you have to find the property, purchase the property, and close on the property all within those 120 days. However, some good news for everyone is that rates have honestly been dropping like every week, even if it's just a little bit. So that rate hold that you have is probably not that good anymore because rates are dropping. So, in today's in a declining rate environment, which is where we are right now, the rate holds are not as important as they were a year ago when interest rates were increasing every week or so.
Right. So is your recommendation to still get that pre-approval and lock in, or is it just kind of ride the wave and kind of see where things are on a regular basis?
I would definitely recommend to get the pre-approval. The rate is not as important now as the actual pre-approval is.
Right.
Just to make sure you have all your documents, you and your realtor can go shop comfortably, knowing what that maximum purchase price is, knowing what you feel comfortable spending on a monthly basis. Like that right now is more important than the rate, because the rate, if we get a 5.5 today, it might be the best rate on the market today. And in a month, it might be the absolute worst. Hopefully,
Right.
does that mean rates are going down?
Yeah. And as they always say, marry the payment, not the rate. Right.
Yes.
So
Date the rate, date the rate, marry
marry
the
the
like the
mortgage
purchase price of
or
the house. Yeah.
the payment, marry the payment, maybe.
Yeah.
Awesome. Well, I think that that covers a lot. Is there any kind of closing thoughts that you have or that you'd like to share?
Oh,
In
I
regard?
think I think as we kind of talked about before we popped on, I think in the next probably 30 to 45 days, I know it's a rush, like this isn't like a sale. I hope it doesn't come across like sales. I honestly think there are a lot of opportunities for clients to
Right
purchase a
now.
property. Yeah. And if client purchase a property today, in like 2 months, I think they're going to be super happy with that decision. In 6 months, they're going to be even happier. And then years from now, obviously, they're going to be thrilled. But
Right.
I think if we're waiting till the spring, I think spring will be a very busy time because interest rates have come back down.
And I think it will become more competitive as well, which means, yes, home values go up. So as a home buyer, now is the time to buy when the competition is low and you're not competing against 10 other people.
You got it. You got
Awesome.
it. Yeah. So
All
those are my
right, Jeff.
final thoughts.
Awesome. Well, I appreciate your time. Obviously, it's always so valuable getting an opportunity to pick your brain and ask you a bunch of questions. We'll be back here next month, and we will chat again about what's changed and what's new and what's exciting going on. And until then,
Can't wait.
we'll chat with you then.
Awesome. Thank you, Michelle.
Jeff, thanks.